One of the biggest questions that we get as realtors and lenders are, hey, what are the options for new construction when it comes to lending? And there's a lot of them, one-time close, two-time close, things of that nature. So I'm with Lisa Blake here with Cadence. She's going to explain the difference between a one-time close and a two-time close.
Okay, so what is the difference between a one-time close and a two-time close? A two-time close is where you go to the bank and you get a construction loan to build your home. With those loans, those are typically ARM loans, so they're not fixed for any length of time other than maybe a year, but again, it's an ARM loan. Your payments during the construction phase are interest-only payments. The downside is when you do a two-time close is that's a temporary loan. So you're paying closing costs when you go to the closing table to close on that construction loan, but when that home is 100% complete, then you have to go to a lender and get your permanent loan, another set of closing costs.
Sometimes, however, there's a benefit for a two-time close, and so I want Lisa to highlight on what that looks like and how that can benefit you.
So the benefit of doing a two-time close is, let's say you're out there and you're building your home and you make some kind of changes or you maybe upgrade your cabinets and you don't have enough money to pay that out of pocket. What the bank will do is they will, if you have enough equity in the property or if the value of the property is already starting to go up, they can order a new appraisal and perhaps lend you more money. But when you do the single close construction loan, that loan closed up front, that loan you can't make any changes to that loan because it's a closed loan. So the single close construction loan is when you go to the table one time and you close on that loan. You're not going back to the closing table, so you're not incurring any more closing fees. That single close construction loan, your rate is locked in for the full term of the loan. Make a float down option if the rates are lower within 30 days of that home being 100% complete, and that's when we turn it over to what we call the permanent phase. During the construction period, your payments are interest-only payments, and that's a question a lot of people ask me is, how are my payments calculated? So every time your builder takes a draw from your construction loan, your outstanding balance, your payments are calculated on the outstanding balance. So let's say the builder has a first draw of $20,000 and it's time for your billing cycle to hit, which would be the first of every month. Your payment's interest only based on that $20,000. I will tell you, your payment could be as low as $50. I mean, it's going to be a pretty low payment to start with, right? But maybe the third month, the builder's pulled out more money and maybe your outstanding balance now is $100,000. Your payment is interest only on $100,000. So that's how the payments work on a construction loan. But when we turn it over to the permanent phase, which is when the house is 100% complete, we send the appraiser out to confirm it's complete. Then at that point, we will start collecting your escrows if you have an escrow account set up.
Right.
That simple.
That's simple. So many reasons why you need experienced realtors and lenders because there's so many different products out there, and we're here to help navigate you, make sure you get to the right lender. She might not be the right lender for everyone. I might not be the right realtor for everyone. But then again, we may be the right realtor and lender for everyone. You never know until you call us.